We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gary Savage, retired entrepreneur, stock and commodity trader, and founder of Smart Money Tracker Premium. Gary, how are you today? Thanks for joining me.
Doing good, Tom. Thanks for the invite.
Always good to have you back and take a look at the markets and see how you really understand how things are playing out right now. And I think this is an interesting time to be talking. You know, we have so many cycles that are kind of converging here. And I think starting with, let's say, what history has shown us about negative events kind of happening coming into September and October here, how does that play into how you're looking at this adding up to the current S&P theory and the almost all-time highs that we're at again here?
So the intermediate cycle, the timing band for the next intermediate correction, similar to like what we had in was it April or May, I guess, whenever that bottom was. So we're coming due for another one of those. It may have started last week. I'll need to see kind of how the first part of this week plays out, whether or not I think that's in play. Also, I think the war cycle may be starting to heat up again. We're starting to make noise about putting troops into Ukraine. That would be a huge, gigantic mistake. And if that's the case, then if the correction's really deep, if we get kind of a mini crash like we had in April, we could make a lower low. And I think I posted on X about this. There's a potential for a megaphone pattern that might be forming. Way too early to say for sure. We'll have to see how how the next correction probably in September, early to mid-September, how that unfolds and how deep that correction is. If we go below those April lows, then that would confirm that we're in a megaphone topping pattern, and the bounce would most likely not be able to make higher highs, and then it'll roll over and we'll get maybe a cyclical bear market. I don't think we're ready to start a secular bear market. I don't think the long-term bull market in stocks is over. AI is still kind of what's driving this bull market. So I think we got further to go, but we could have a cyclical bear market and a recession, in the middle here as we progress through this longer term bull market. Mm-hmm. So we'll see what September brings. If it brings another mini crash like we had in April, then we're probably heading into a recession and a cyclical bear market.
So with that megaphone pattern, Gary, is that something specifically that you're looking at as a technical structure that informs that next direction if we break those bands?
Potentially, yes. And I can share the screen here and kind of show you what I'm talking about. Okay, so this has the potential to be something like this. Now, it's going to depend on where we go in September, maybe even into October during that next intermediate cycle low. So here's an intermediate cycle low. Here's an intermediate cycle low. Here's one. The warning sign came right here when, as this intermediate cycle decline played out, it went deeper than I expected. In a strong bull market, generally, these don't drop below the previous intermediate cycle low. So this is the previous intermediate cycle low. You can see it went below that. But not only that, this was the yearly cycle low for 2024, meaning that this was the lowest intermediate cycle decline of that year. And we went below that as well. So kind of warning bells going off when that happened.
So the first one was in April, just for our audio listeners in case they're not looking at the chart here.
Yeah, this was in late April. Mm-hmm. And then our next intermediate cycle decline came in early August, I guess it was. And then we have this decline here that not only drops below this intermediate cycle low, but drops below the yearly cycle low. So a warning bell is going off like that generally doesn't. But then, of course, what happens is the central banks, they print a lot of money, and you get this volatile, aggressive move back up, makes a higher high, although the transports are not confirming, the housing index is not confirming. The banking, I don't think the banking index has made higher highs. So there's some warning bells going off. There's some divergences. There's also a Dow theory sell signal that's still in effect. I don't think the Dow closed at a new high either. So the S&P did, and basically what this means is potentially there's something that is in the process of breaking in the economy. And that's why we get this really deep move back down that drops below this previous yearly cycle low. And then the Fed tries to fight it. And so you get, a bunch of money printing, and that powers this really aggressive, violent move back up that makes a higher high. But then at some point it rolls over again. And like I said, we're going to be due for that next intermediate cycle low, probably in early to mid-September. If it plays out as some kind of a crash event, and there'll need to be a geopolitical component. I think the troops, or you make it clear they're going to put troops into Ukraine, and if that was to happen, or something else, and then we get a move back down that drops below this pivot, that would confirm that we've got a megaphone topping pattern in play. And then generally what would happen is somewhere there you get another bounce, but it won't make higher highs. It'll maybe come back up to the middle of this pattern, and then break down out of the lower trend line of this pattern, and you'll get a cyclical bear market and a recession. So that's kind of what I'm watching here. I'm kind of waiting to see whether the bounce today holds, how the rest of the week plays out. If we zoom in a little bit here, if we haven't broken this daily cycle trend line yet, which makes me a bit suspicious that this is over. This daily cycle decline is over. We may have a little further to get moving average. So kind of want to see how the rest of the week plays out.
Gary, how do you see, let's say, the effectiveness of the Fed here the next time we get one of these lows here? Of course, we haven't seen them drop rates again. We technically haven't seen the end of QT. So how are they injecting liquidity to drive that last spike?
Oh, I think they're just, banks are just borrowing money from the Fed at basically 0% interest rates, or very close to it, and they just pump it into the stock market. They're clearly doing it. You don't get a rally like that unless you got liquidity flooding into the system. Generally, a correction that large would require months, maybe even a year to recover, but you recovered it very quickly. So I think it's just standard policy whenever we got some kind of serious correction in the stock market or whatever, and almost all of the corrections for this whole bull market have played out that way. The Fed panics, central banks in general panic, they print money, and the markets come roaring right back. This one, although I'm worried that the Ukraine is going to escalate, and that potentially something is trying to break in the economy. And they did this back in 2008 too, when the housing market was starting to unravel. They printed a bunch of money, and we had that same megaphone topping pattern. The Fed would print a bunch of money trying to stop the collapse of the housing market. We'd get a violent move back up, made a little bit higher high, but eventually the fundamentals overwhelm the money printing, and generally what happens is the money printing creates a lot of inflation, which is what happened in 2008. Oil went to $147 a barrel. And so all they did was they just made the collapse even worse, because they spiked inflation, which crushed the middle class and the lower class. So that may be potentially what's getting ready to happen here as well. We'll just have to see. I'll need to see how the rest of the week plays out.
You mentioned the war cycle and these escalating tensions in Ukraine. Does that act as a catalyst, or you know, a geopolitical event like that, does that act as let's say the kickoff or the reason for a technical move, or is it the technical move that precedes the actual event?
Well, it may be that that's what's breaking. The market is anticipating that the war cycle is going to escalate. Um, and for the S&P to drop below that April low, I think we need a geopolitical event. If we don't have it, if we're not escalating the war in Ukraine or the Middle East or something like that, or something out of the blue that we're just not seeing yet, then I don't think the move into September would be that bad. I don't think it would go below the April low. But if you have something exacerbating the move, like, we're starting to amass troops on the border of Ukraine. Well, obviously, you don't spend billions and billions of dollars to move troops around unless you're going to use them.
Mm-hmm.
So if that starts to happen, if we start to see, troops being moved over to the border, well, obviously the war is going to escalate, and I think that would drive the S&P. That would drive that correction in September, maybe even as late as October. But I think it would drive the S&P below that April low and confirm that we got problems and we're probably about to enter a cyclical bear market.
Mm-hmm. And Gary, just to go over it, what is let's say the typical length of the war cycle, and let's say the last time we kind of saw a spike in it?
I haven't really studied that, but my best guess is, they probably last 3 to 4 years. It might be shorter. I'm going to guess, well, based on how long I think the 8-year cycle is going to rally in gold, because I think the gold cycle is going to rally as long as this war cycle continues. I think that's one of the things driving the move in gold. And I'm anticipating maybe 2027, 2028. So that'd be my best guess, is the war cycle could last till then.
Okay. Before we move on to gold, I just wanted to get your thoughts as well on, let's say, once the Fed reacts again, does that cause us to kind of go into a possible melt up situation and push past and eclipse even the highs that we have seen in the stock markets?
Um, it could, if they well, it depends on how that megaphone pattern plays out, if it's in play. It could, although, like I said, I think this would be a cyclical bear market, not a secular, which means that we would get a correction that could last a year or more, and then the Fed, prints a bunch of money, and then we get a kind of a bubble top in the stock market that occurs, maybe after 2028. Likely, in my opinion, is that we get the final bull market top parabolic move after 2028. Then, like, if we have a big correction in September, the Fed panics and cuts rates, and then that pushes the stock market up to 7,000 or whatever. Not my preferred scenario. I think it's more likely we get a cyclical bear market first, and then we get our final move in the stock market after that.
Mm-hmm. So how do interest rates play into how you're seeing that, let's say, that that reaction from the Fed, and B, how the bond markets end up reacting to that as well?
Well, I think we're still stuck in an inflationary period. So if the Fed makes the mistake of cutting interest rates, it'd be probably a big driver to push gold into. I tend to think that the gold is going to give us a final bull market top during this 8-year cycle. So, like I said, maybe cutting interest rates combined with escalation of the war cycle would give us a final top in the gold bull market, maybe around late 27, early 28, something like that. So personally, I think it would be a mistake to cut interest rates when we're still in the middle of an inflationary cycle. I think Burns did that a little too quickly in the 70s, and then we got that huge inflationary spike. Probably same thing would happen here. They cut interest rates, cut them a little too soon, and it, it ignites the inflation cycle again.
Mm-hmm. So, when you're talking about gold lately, you're taking this longer term view and really showing how long this basing pattern has been that builds, let's say, the energy and the momentum for that spike up. So taking that longer view, run us through again what you see as the timing, let's say, for that eventual peak in the gold market, and whereabouts you see that.
So let me share the screen again, and I'll show you I posted this to Twitter as well. The bigger the base, the higher in space. So it's pretty clear on the long-term chart of gold. And I think we still got more churning to do in gold. I'm not convinced we're ready to break out yet. I think the dollar's got a little bit more to rally in this sideways consolidation. So I think we're getting fake outs in these rallies. Once they get overbought, then they go back down. So I suspect the rally here the last couple of days is probably going to be another fake out. Mm-hmm. But here's what I'm looking at. Second here, let me move this out of the way. So we've got this basing pattern that started here back in 2011. Cup and handle, everybody's pretty familiar with that. And then this was a move down into an eight-year cycle low. This was an 8-year cycle low. So the first thing I'll point out is we're still pretty early in this 8-year cycle low. We're not even 3 years in yet. Mm-hmm. So I think we've got, we may have another 3 years to rally still. I do think that the breakout from this cup and handle is kicking off that final rally to the final secular bull market top. But the size of this base, which is, 13 years, I guess, from this peak, we got some kind of false breakouts here as we formed this handle. But if you go with the principle, the bigger the base, the higher in space, 13 years in the making has a lot farther to go. Mm-hmm. And this is why I keep saying $10,000, I think, is going to be a piece of cake. And I'll qualify this as I always do. Doesn't mean it's going to be an easy move and it's going to go straight to 10,000. There could be big corrections, 30% pullbacks along the way, but it just means that it's going to get there. The same as, years ago when I said before the NASDAQ had even gotten to 5,000, I said, well, we're going to get to 5,000 and we're going to go to, 10,000 is going to be a piece of cake. Mm-hmm. And 20,000 is, within the realm of possibility. Well, we're at 21,000. So I think the same thing. And along the way, we had some big, scary, pullbacks. We had the crash and the COVID move, big pullbacks along the way, but it did do. We got to 20,000 and we're above 20,000 and probably still have further to go. So I think based on the size of this base, 10,000 just looks like a piece of cake to me. So any pullbacks, even when they're really scary, and I suspect that as we get further and further into this, it's going to get more volatile. The pullbacks will be scarier and look more convincing, like the bull market has ended. But I just based on the size of this base, I'd say 10,000 is probably easily, and we could go above 10,000. I wouldn't even put 15,000 out of the question when we get into that final parabolic bubble.
Mm-hmm. Well, as we think about the let's say the behavior of that final bubble or that parabolic move here, is it possible that we aren't far from entering that phase for gold where it really enters or re-enters the public consciousness and average people start to chase it because they see their neighbor making lots of money? And is that what drives that parabolic move?
Yeah, exactly. I could make a case that maybe we're starting right here, but I don't see a lot of the public really taking notice yet. So my guess is somewhere here we're going to have kind of a big scary correction. Maybe it's a half 8-year cycle low. So far, ever since we broke out of this, the corrections haven't progressed as a normal intermediate cycle low, which generally is kind of an ABC scary move. None of these have progressed that way. They've all turned into these sideways churns. So here was one here, and then we got the triangle pattern, same thing here, sideways churn, doing it again here. I was kind of thinking that this ICL might unfold as a more normal correction where we get an A wave down, a B wave bounce, and then a scary move like maybe all the way back to 2,800. Hasn't played out that way. It's played out as another one of these sideways churns. So my guess is that the maybe the public is starting to take notice. And once we come out of this sideways churn, maybe we go to, I think this tacked on what was about 700-800 points. So if we assume something similar, 700 or 800 points, that puts us maybe somewhere between 4,000 and 4,300. That's probably going to start to get the public attention. And then that might be the point at which we get a more normal ICL that's scary and maybe takes gold from, let's say, maybe 4,300, gets everybody too bearish. And then once we start the next leg up, that's the one where the public really now they're starting to be convinced. And generally speaking, it takes about a year to a year and a half once the public starts to take notice and pile into a market. So let's say we get to 4,300, we get a more normal ICL that's scary rather than sideways frustration. That bottoms, we break out, we start to move above whatever that peak is, and the public starts to come in. And at that point, I think that's where you've got about a year or a year and a half into that final top.
Mm-hmm. So, Gary, when we think about going into those tops, how do you think about, let's say, selling into those tops? Do you sell in stages to take profits off the table as we climb, or do you wait for a particular target and then sell, a big piece or if not all of your position as we're going into that top?
Well, at some point, because these parabolic moves, they crash. So when the top comes, it can literally, the bottom can fall out, especially in silver. At some point, you have to control greed. So I would say you probably want to sell in stages. So I'm pretty sure silver is going to get to $100. Same thing, piece of cake. Mm-hmm. The basing structure is just gigantic in silver. If you think this basing structure is big, silver, makes this look like child's play. So that's why I say $100 piece of cake. I mean, that's only a double from the old all-time high. Mm-hmm. 250 is, in my opinion, is probably also a piece of cake, and 5 out of the realm of possibility. But if we get to $250, I'm selling some of my silver, maybe half. At that point, I've made an insane amount of money. And then, maybe every $50 higher after that, you sell some more until at some point you just say, hey, this is obviously a bubble. I don't have any idea where it's going to top. I don't want to get caught, when the crash comes. So, you just gotta, at some point, you just gotta be happy with your gains, and you get out, and then you just kind of bide your time and you look for something else that's undervalued. maybe we were having a big correction in the stock market at that point, and you don't think the bull market's over, the long-term bull market in stocks is over. So maybe that's the point where you sell your metals, and it's time to go back into the stock market for maybe the final move to the bubble top. I'm not really sure how it would play out at that point, but it's not that hard to spot bubble conditions. And when you see them, at some point, you just want to make sure I don't get caught in the crash.
Mhm. Gary, do you use ratio charts to kind of inform where those spots might be? Let's say like gold to S&P or gold to the Dow, to show you when that rebalance or when you want to rebalance like that into a different asset?
Absolutely. And I think the one chart that I'm going to be keeping a close eye on is the gold to silver ratio.
Mhm.
Um, the last bull market topped kind of strangely. Silver topped first, and then it was several months later that gold topped. I kind of think this one, they'll probably top together. So I'm going to be watching the gold to silver ratio. I suspect it's going to get back down to 30-1, maybe even as low as 20-1. When you see that, it's time to sell. You got it. The bull market in the metals is done. It's over with. You didn't move your profits from the gold, the precious metal bull market to something else.
Mhm. Do you think that the short position in silver is a really important piece of the puzzle to take into consideration when you're looking at these charts and trying to determine a target for silver?
I do think silver is trying to break the manipulation that's been in effect for decades. You can see as we came out of this was the April stock market crash. It infected silver as well, not so much gold, but the market changed. And let me zoom in just a little bit here. So the banking cartel, they just spent weeks and weeks trying to keep silver below this, let's call it $33 resistance zone. We get the temporary spike up, and then the bankers got a gift in that kind of a stock market crash took down silver too, and allowed them to get out of some of their shorts. And you can see this is what happened as they're trying to cover those shorts as we get a violent rally back up. But they, again, just weeks and weeks trying to prevent silver from getting back above that $33 resistance, 37.50. And this goes all the way back to like 2011 is where this resistance zone is. So it spent several weeks trying to hold silver there, broke out. And then we had the psychological resistance at 40. And I think I posted to X that we were probably not going to go through 40 on the first attempt. Just psychological resistance. There's going to be natural selling there. The banking cartel would try and exacerbate that if they can, and they certainly did. I tend to think we're probably going to get, and let me convert this to daily so I can kind of show you how this has worked. This looks like it's probably going to be a daily cycle low in silver, but I don't necessarily think this is a final intermediate cycle low in silver. This doesn't always play out 100%. It certainly didn't right here. But most of the time, these play out as an ABC move. We're probably getting ready for our B wave bounce. And then we may have to have a C wave that comes down and fully tests this 35.50 support zone. Right around here. And you can see this is how it played out during the last intermediate cycle low as well. Here was our A wave down, very convincing B wave bounce, but once it got a little bit overbought, then it sold off again, and we get an undercut of this pivot, and that's our final intermediate bottom. And then we start our next rally, and then we get to kind of an unusual intermediate cycle low that's driven by selling pressure infecting silver from the stock market move down. But this intermediate rally is pretty mature. Looks like a daily cycle low to me. So I would be leery about trusting this rally. I think when it gets overbought, it may have to come back down and undercut this a little bit. And I doubt that it's going to go below 35. It could, it might get back down to this 33 level, but I doubt it. I think it's probably, I think this $35 support's going to hold. And I think that will set the stage for a rally to $50 before the end of the year.
Gary, how does the strength of the dollar play into that as well? Because, obviously as the measuring post for the metals, that has a lot to do with it. So does that, let's say, the dollar strength really play into your analysis for how you see these, let's say, this shorter term behavior of gold and silver for those intermediate lows?
So, barring an immediate escalation of the war cycle, then a dollar rally is probably going to keep the metals trapped in that, gold anyway, is probably going to keep it trapped in that sideways consolidation. So these rallies will probably continue to be fake outs that will not be able to hold an overbought condition, and will turn back down as soon as it gets a little overbought. Gold too far above the 200-day moving average, in my opinion. They probably need to go sideways a little bit longer, allow that 200-day moving average more time to catch up to price. And let me put the dollar chart up here, because I think it has more to rally. Don't think the dollar's quite done rallying yet. The intermediate cycle is still pretty young. So I think what's probably happening, you can see here, the dollar rallied, it got to the 50-day moving average. The shorts came back in, took it back down, but they couldn't take it back below this. As soon as it got a little bit oversold, this is just generally what happens. If you're in the advancing phase of an intermediate cycle, oversold conditions spark the next rally. They don't. And then this rally took the dollar back above the 50-day moving average. I think we're probably going to come down, maybe test that 50-day moving average, and then come back up. And the dollar just got stretched way too far below this 200-day moving average. We need to shrink some of this gap. We probably still need to shrink more of it. But I don't necessarily think that the dollar is going to be able to, I don't know that it's going to be able to get back above the 200. If it does, I don't think it'll be very far. And then we'll move back down again. We'll start another leg down, and I think the dollar's probably in a secular bear market. So this, in my opinion, is probably a counter trend rally that's not going to be able to get above this peak. So it's going to make a lower high, mm-hmm. And then it'll roll over again, and it'll make a lower low. So on a weekly basis, the dollar, you can see it got heavily oversold and had divergence. That's probably where we got our intermediate bottom. We're 5 weeks into this intermediate rally. They usually last 8 to 10 weeks, maybe 12 weeks on the long side. I don't think the dollar is going to be able to get back above the 200-week moving average. So somewhere in here, I think it's going to top, not make a higher high, and then it's going to roll over and make a lower low. Probably by the time this 5-week RSI gets, if it can get overbought, that's the point at which, if you're trading currencies anyway, that's where I would short the dollar again, because I don't think it will be able to hold an overbought condition on the weekly charts.
Mm-hmm. So Gary, as a proxy or as part of the metals complex, how do you see gold miners behaving right now? And does that give you any information as far as where we are in the cycle, or how the cycle is progressing as that capital kind of like flows into that sector of the metals market?
Yeah, so you can see on this chart, this longer term chart, we're at a major resistance zone. I doubt the miners are going to get above it. I think these are probably, fake out rallies here. And let me put this this is the 50-week moving average. The 40-week moving average is kind of the same thing as the 200-day moving average. And you can see the 40-week is probably somewhere right around in here. You can see we're stretched really far above these moving averages here, and we're right up against this resistance. So I have my doubts that the miners are ready to break through this resistance. I think they're going to keep getting rejected by this resistance for a few more weeks, probably, for as long as that dollar rally continues, which I think is going to keep gold churning, mostly sideways with these kind of fake out rallies. Now, let me stress again that this could all change if the war cycle escalates. If the war cycle escalates, gold's going to come out of that consolidation regardless of what the dollar does. The dollar will be meaningless. The miners could break through this resistance because they'll follow gold. That an escalation of the war cycle would probably take the stock market back down. It would probably have opposite effects. It would probably take gold up, probably take stocks down. Silver at this point, I think, would probably follow gold higher. So I'm assuming right now, barring an immediate escalation of the war cycle, that we're gonna probably stay stuck underneath this resistance level in the miners for a bit longer, and we're going to stay stuck in that consolidation in gold for a bit longer. And during that process, silver may have to make a B wave bounce and then a C wave that maybe fully test 35. And then, like I said, I think once we do that, I think silver's set up to completely break the banking cartel suppression and go to $50 by the end of the year.
So do you look at, SIL or SILJ as a vehicle to play that particular move?
You could, or you could just play SLV with leverage, get the same thing. What I like to do, what I do with the SMT is since we are in the advancing phase of an 8-year cycle in metals, since we have broken out of a 13-year cup and handle pattern, and since I do think that we're probably going to get that final parabolic bubble phase during this 8-year cycle, I try to play leverage when I think we're coming out of an intermediate cycle low in metals, or if I think a sideways churn is ending and we're ready to start the next leg up. So, we'll buy some, maybe like some call options on SLV or GDX or GLD. I wouldn't really buy call options on SIL. It's not liquid enough. The spreads are too wide. But if you want to get some outperformance, you could just buy some call options on SLV. Give yourself plenty of time to weather the wiggles back and forth. But that's generally how I would play it, rather than trying to buy something that doesn't have a lot of liquidity like SIL or something like that.
Gary, how often are you making trades, like going in and out of the market? Do you look at these things and try to play them over months? Like, how frequently are you entering or exiting trades?
So generally what I want to do is if I can spot the bottom of an ICL, then and I will say that ICLs, if they play out as an ICL, as an ABC move, and it's scary, it's much easier for me to spot the bottom. And then that's the point where we can maybe take some leaps, long expiration call options, something that has a year to expiration. That's generally what we do. So we got plenty of time. It's harder to pick the bottom. The bottom may have occurred, weeks or months ago, but it's hard to determine when the breakout's ready to happen, because that's when you're, actually going to make some money. You need the next trending move to start. So, like I said, I think the dollar has a little longer to rally, and so I think everything's going to stay in a churn a little bit longer. But at some point here, we're gonna either add to, some people have already added to some long-term call options, banking that we don't have that much longer to wait in the metals. And if we do break out, then we'll immediately go to full positions or add to any positions that we have. But as of right now, I still think we may have some more churning to do.
Excellent. Well, Gary, is there anything that we haven't covered that you think is worth paying attention to at this point as well?
Oh, I'm not really interested in energy, not terribly interested in Bitcoin. For the S&T, I made it clear at the beginning of the year, because of that 13-year cup and handle breakout, I'm really only interested in playing the metals at this point. So, I'll open the S&T up again to new subscriptions in December. It's closed right now, but once December comes around and we get another year, then I'll open it up for yearly subscriptions, and that's mostly what I'm doing at this point, is just focusing on the metals. We're trying to catch those two ICLs that occur every year. Usually, you get one in the spring, and you'll get one in the summer or early fall. And as long as the bull market's still intact, we should be making good money. I think we still got 2 or 3 years to go. So that's what I'm playing in the S&T right now, at least until the end of the gold bull market. Is I'm just trying to focus on the metals, and when we get these dull periods where it's churning or correcting, then we just kind of sit and twiddle our thumbs. I don't try and make a whole bunch of different trades in a whole bunch of different markets trying to make something happen. We just bide our time until the next setup in the metals.
Yeah, it seems again to receive these clear signals, I think, and then act upon those isn't a terrible way to go about it, right? It probably helps you sleep at night and not necessarily take up a lot of your bandwidth during the week.
Yeah, it's just it requires patience, because there are periods like this where things just go sideways, and people, they get frustrated or impatient, and they want to jump over to another market and try and make some money there. And generally what happens is you end up over trading and you lose some of your gains. So we made some really good gains up to that April top. And now we're just kind of, biding our time, waiting for the next period where we can add to that. And we just don't want to lose a lot of those gains trying to jump around looking to make something happen somewhere else. And then we're just starting from a little bit lower position on the next good opportunity. That's not what I want to do. I just want to be patient, kind of ignore other markets for the most part. And then when I think we're ready to break out and make that next run to 4,000 plus, hopefully we will have kept all of the gains from that run into the April top, and then we can add to it during the last part of the year.
Excellent. So for those that are interested, of course, all of your stuff is available at smartmoneytrackerpremium.com, and you're an excellent Twitter follow as well, at Gary Savage1. Gary, thanks so much for your time today. Always appreciate it.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.